Toronto's condo apocalypse and the looming U.S. housing crash. Toronto's so-called condo apocalypse is the culmination of years of global monetary excess, unparalleled asset inflation, and ultimately a painful correction now playing out across the city's skyline. Triggered in part by the 2008 crisis responses, when Federal Reserve Chair Ben Bernanke's ultra-low interest rates and quantitative easing flooded global markets with cheap money, the seeds were sown for a decade-long international asset bubble, in which Toronto became one of the most prominent showcases. Origins: from Bernanke's bailout to worldwide bubble. The 2008 financial crisis led the U.S. Federal Reserve to set interest rates at record lows and embark on massive bond buying programs. These measures were not locally contained. Global capital, awash with liquidity, chased returns in every advanced market, fueling a synchronized inflation of real estate prices from London to Sydney to Toronto. The COVID-19 era poured gasoline on the fire. Both fiscal and monetary responses were historic in size and recklessness, vastly expanding the money supply even as local economies stood still. The result was a spectacular run-up in housing, with Toronto's condo market becoming an emblem of this speculative euphoria. The height of mania, condo frenzy in Toronto. By 2021-2022, Toronto's condo market was boiling over. Prices reached historic highs, utterly detached from local economic fundamentals. The average selling price for new construction condos peaked at $1,689 per square foot in Q3 2022, while resale prices shot up and new project launches stoked bidding wars. Investors swarmed pre-construction sales centers, often taking on multiple mortgages, sometimes 2, 3, 4, or more per household, on the belief that prices would double before completion. The idea was not to live in these condos, but to flip them, selling on assignment, pre-completion, for a quick profit. Assignment sales, where buyers sell their pre-construction rights before taking ownership, became a booming shadow market. Developers depended on these eager buyers to meet pre-sale thresholds needed for construction financing, further inflating demand and fueling a feedback loop of ever-rising prices. The investor-driven market. The investor share of Toronto's condo market ballooned. By 2022, estimates suggest 65% of small condos, under 600 square feet, and 40% of all condo units in Toronto were owned by investors, not owner-occupiers, but people banking on rent or flipping profits. For pre-construction sales, this share may have reached 70 to 75%. Some buildings were almost entirely owned by investment entities, effectively operated as shadow rental complexes. The tipping point: interest rate hikes. The underlying weakness of this investor-led mania was exposed when the Bank of Canada began a series of aggressive rate hikes post-2022. Borrowing costs doubled, and the business model collapsed. The carrying cost of new mortgages could not be covered by softening rental income, and buyers could not flip units for a profit in a falling market. Many could no longer close on their pending condo purchases. The assignment market imploded, with would-be flippers unable to sell even at loss. Collapse: plunging sales and price declines. The crash has been historic. In Q1 2025, total condo sales plunged 21.7% year-over-year, with pre-construction sales at their lowest since 1995. Analysts note a 64% fall in new condo sales from 2023 to 2024, the worst in nearly 3 decades. Prices have tumbled, down 14 to 21% from their peak, with many units now sitting on the market for months without takers, even after 25 to 30% price reductions. Inventory has soared. Toronto faces nearly 8 months' supply, far above balanced market norms. The reality is grim. There was never real, end-user demand for many of these condos. These were speculative units, purchased with borrowed money under assumptions of perpetual price growth. As the air comes out, Developers are canceling or deferring projects. A record 28 buildings and 5,700 plus units have been shelved or converted to rental in 2025 alone. Construction starts have dropped 79 to 88% below the average, setting up a future housing crunch even as today's market languishes. The aftermath. Unprecedented reset. Toronto is now experiencing its most severe condo market downturn in over 30 years, with historically low sales, plunging prices, excessive supply, and widespread investor distress. Recovery is not expected before 2026, and even then, scars from this speculation-driven collapse will reshape policy and public perceptions for years to come. The condo apocalypse was no accident. It was the foreseeable result of unchecked speculation, policy misfires, and a housing market built atop a mountain of debt and unrealistic expectations. Spreading crisis. U.S. markets face condo and housing turmoil. The same speculative dynamics and painful correction seen in Toronto's condo market are now increasingly visible across major U.S. markets, including Florida, Texas, and several major Sunbelt after years of low interest rates and an investment-driven housing boom. U.S. markets that mimicked Canada's pattern, rapid asset inflation, investor speculation, and overbuilding, are now seeing cracks emerge. Cities such as Phoenix, Cape Coral, Florida, and multiple Texas metros, Austin, Dallas, Houston, have experienced sharp price declines and inventory surges in 2025, much like Toronto's downturn. It's just a matter of time before the situation seen in Toronto, and now spreading rapidly across major U.S. condo and housing markets, morphs into a potential full-blown housing crash in the United States as well. Please like, share, and subscribe to stay updated on future real estate market analyses.